What's up everybody? GenExDividendInvestor here. In this awesome video that's filled with tons of valuable dividend investing information, I'm going to tell you about two high-yield dividend stocks in the SP 500 that are beating the market both year-to-date and over the last 5 years. I'll also mention the remaining high-yield ones in the SP 500 that are beating the market this year, but not over the last 5. But before I tell you about the high-yield dividend stocks, I'm going to spend the majority of this video sharing a bunch of interesting things about dividend yield, yield on cost, investing risks, and reasons why certain investors do poorly in the markets. So if you're too impatient for all that info, then feel free to use the timestamp on screen to jump to the section of the video where I just go over the stocks. Regardless, please do me a favor and thump that thumbs up button, subscribe if you haven't yet, and click that bell notification. I also want to strongly encourage you to join my free Dividend Discord chat server. I have thousands of investors on it from around the world, and you never know who you might be talking to on it, as I have tons of fascinating users, including a YouTuber who has millions of subs, and a guy who played in the NFL for about 10 years, along with some self-made multimillionaires and of course a bunch of people at varying stages of their investing journeys. All you do is click on the Discord link that's both in the description of this video as well as in the pinned comment, and then once you join, then either myself or my moderator, Man8V, will authorize your access. I work hard to keep my dividend investing Discord filled with great people on it, and I get rid of toxic or negative folks that can't follow my server rules. So I say no porn, no politics, no bashing others or being disrespectful, no spamming advertisements, stuff like that. It's a positive chat environment where you can learn and interact with other investors 24 hours a day, 7 days a week, and like my YouTube channel, I make sure it's high value even though it's free. If you're new to my channel, then welcome. I've been investing for over 25 years and my passion is around dividend investing, though I also invest in growth stocks and crypto, and my goal is to share the positive, life-changing realities that dividends can enable. Speaking as someone who was able to retire in his 40s due to dividends, which I've been using as the primary source of my income to pay bills. So it's not a clickbait thing where I say I'm living on my dividends and then you find out I'm using them to pay for an occasional coffee or something. No, I literally am using my dividends to completely pay the mortgage, health insurance, gas, etc. Having that truly passive income flow is as amazing as I first hoped it would be when I started investing. To be honest, it's far more amazing than I thought it would be. So to misquote Denzel, money doesn't buy happiness, but it's a heck of a down payment though. Of course, I've made tons of investing mistakes over the years and have learned things that worked and didn't work, and one item that is important for people to understand is risk, especially from higher yield investments. And because my YouTube audience has a wide range of investing experience, it's sometimes valuable for me to cover some basics to ensure we're all on the same page. So dividends are usually quarterly cash payments made to shareholders by some public companies. It's as simple as you buy a dividend stock, like Johnson & Johnson, and then for potentially the rest of your life you will keep getting cash payments from them every 3 months. And every year you'll probably get a dividend raise as well. Yes please, I'll have another. That's what she said. Now companies offer dividends to incentivize people to invest in their stock, as the more people that invest, the more a stock tends to go up. Of course, the best way to get sustained stock prices is if the company keeps growing itself. Many companies do not pay dividends and instead just reinvest their money in their own business in order to grow faster. I found that large established companies with predictable profits are often the best dividend companies, companies like Procter & Gamble and McDonald's and such. I absolutely love seeing dividend cash flowing in without working for it, whether I'm sleeping or playing video games or whatever. Warren Buffett once said, if you don't find a way to make money while you sleep, you'll work until you die, and dividends are the purest form of passive income I've ever found by a mile, and each share I buy I feel like I'm planting another cash-growing tree on my income farm. Each share lowers any financial stress I might have, and that additional health-related perk of dividend investing is hard for me to put a price tag on. Each share is buying the most precious asset in the world, time. Time that your dividends will give you down the road by saving you the need to keep working. Of course, it's important to realize that companies are under no obligation to pay dividends and can reduce or eliminate their dividend at any time. But reducing a dividend usually results in a drop in stock price, so responsibly run companies will be very careful before they announce a dividend change. Now, a common saying amongst dividend investors is don't chase yield. I want to elaborate on what that means because it's critical for you to understand it if you want to be a successful long-term investor. It basically means don't just look for the highest yield stocks and buy those in hopes of making more in dividends faster, because it's often true that the higher the yield, the greater the risk you're taking. With greater risk can come greater rewards, but also greater loss. Let's look at an example of a higher yield stock that I own, and that's Altria, ticker MO. At the time I'm doing this video, Altria has a 7.06% yield. What that basically means is for every $100 you invest in Altria, assuming your broker can buy fractional shares, then Altria would be paying you about $7.06 a year merely for owning it. And then if they increase their dividend, which Altria has done for over 50 consecutive years, then the next year you'd be making even more than $7.06 on your investment. Or to put that differently, if you bought one full share of Altria, which today costs $50.97, then your one share of Altria would make you $3.60 per year. And since Altria pays out quarterly, that means they would pay you 25% of $3.60 every quarter, which is 90 cents per share you own. Since dividend yield is the amount of dividends paid out in a year per share of stock, divided by share price, we see that $3.60 divided by $50.97 is 7.06%, which is Altria's current dividend yield. Generally speaking, the amount a company pays out as a dividend is voted on by their board of directors once a year. Thus, since the amount they pay out is generally fixed for the year, then as stock prices fall, the dividend yield goes up, and when a stock price goes up, dividend yield goes down. When you buy a stock, you get the yield at the time you bought it, which just means your annual return from dividends will be that percentage of the cash you invested, which at that point is the same as your yield on cost, which is just a measure of dividend yield calculated by dividing a stock's current dividend by the price initially paid for that stock. And then your yield on cost gets adjusted based on any hikes or cuts they do. So if you're in a strong company that consistently raises their dividend, then your yield on cost keeps going up because the numerator, aka the dividends per share, is being increased, while the denominator, aka the share price when you originally bought it, remains the same, at least for that purchase. I'll show you an example so it sinks in. Let's say I bought 5 shares of a stock 20 years ago at $20 a share, so in total I spent $100, and let's pretend it paid out $1 in dividends per share per year. So its yield at the time I bought it was $1 divided by $20, which equals 5%, and thus my yield on cost at that point was also 5% because my cost basis per share was $20 a share. Now let's say 20 years go by, and after a bunch of dividend hikes, it's paying $5.60 a share, and each share costs $135. My yield on cost for my original shares would be $5.60 divided by my original purchase price of $20 per share, which equals 28%, which is a huge percentage. Next, let's assume I buy 100 shares at that $135 a share price for $13,500. The yield of those latest shares I just bought would be at 4.15%, i.e. $5.60 of dividends per share divided by 135. So what is my overall yield on cost for all my shares across those 2 tranches of purchases? First, let's identify what my overall cost basis is per share. We take the $100 I originally spent plus the $13,500 I just spent, which equals $13,600, and I divide that by my total number of shares, i.e. by 5 plus 100, and we get $13,600 divided by 105, which equals $129.52, which is my average price per share that I've spent overall, aka my cost basis per share. That means my overall yield on cost for all my shares is the current dividends per share of $5.60 divided by my overall cost basis per share of $129.52, and that equals 4.32% only. How's that possible? How can my original tranche's yield on cost be at an amazing 28%, but my overall yield on cost for both tranches only be at 4.32%? It's because when we calculate your yield on cost for a stock, we want to factor in all your purchases, and in this case, the most recent purchase impacted the overall yield on cost far more than the original small purchase, since significantly more shares were bought at a higher price in the second tranche. Thus, while your original tranche's yield on cost is fun to see and talk about, unless it represents the majority of your cost basis, then it's almost a useless metric as compared to your overall yield on cost, which factors in all your purchases over time. Also, while it's fun to see a rising yield on cost, be aware that it's mostly a backwards-looking measure and doesn't guarantee a company's future growth potential. It just tells you that a dividend has been rising or falling since your original purchase. You also need to be careful that you don't fall in love with the stock simply because your yield on cost is high. It's possible you have a great yield on cost, but that you're holding the next blockbuster video. I did a video called When to Sell a Stock if you'd like to hear my perspective on when I'd sell a stock. Now, one thing that I think would be good to clarify is that it's not your brokerage that is paying you dividends. So it's not technically correct if you see a thumbnail that says Robinhood paid me blah 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 in dividends, though it does get more clicks to mention Robinhood or M1 or something in a thumbnail. What actually happens on the dividend pay date is that the company that's paying you the dividends deposit funds designated for their shareholders with the Depository Trust Company, aka the DTC. Then the DTC disperses the funds to brokerage firms around the world where shareholders hold the company's shares, and then the brokerages either apply cash dividends to client accounts or they process reinvestment transactions like DRIPs, as per client instructions. Always be aware that tax implications for dividend payments vary depending on the things like the type of dividend declared, the account type where the shareholder owns the shares, and how long the shareholders own the shares. Dividends have been around about as long as the stock market has existed, and the oldest dividend stock in the US actually paid its first dividend around when we had the Revolutionary War, and that was by a tobacco company named Lorillard, which paid its first dividend in 1760. Lorillard was bought by Reynolds American, which is a subsidiary of British American Tobacco. The first company ever to pay a dividend was the Dutch East India Company in the early 1600s. Okay, now let's compare Altria's yield to the overall market's average yield to get a sense of why I say Altria's yield is a higher one, though not too high for me. This graph tracks the S&P 500's average yield since the 1800s, and we can see it's been on a downward trend over time, and today it's only around 1.3%. You can see that from the 1800s to mid-1900s, yield never fell below 3%-ish, but then started trending below the 3% level starting in the 1990s. Why? Well, number one seems to be because the Fed began lowering interest rates, which then drove down the equity risk premium on stocks, and so the markets became flush with cheap money, which then acted as a catalyst for stock prices to climb faster relative to the dividend hikes that boards of directors were doing. Another key contributing factor to average yields declining was that a bunch of new tech companies joined the markets around the birth of the internet, companies which were primarily growth-oriented and that paid little to no dividends. Anyways, another way to estimate the S&P 500's yield is to look at VU's yield, which is an ETF by Vanguard that basically represents the S&P 500. So why don't you just find the highest yielding dividend stock so you can get the most returns? Well, because often you'll find that the higher the yield a company has, the greater the risk the market perceives in it, which can mean higher rewards if things work out, but it can also mean worse returns and/or losses if it doesn't work out. Note I said often, not always, as I'm trying to talk in generalities, not definitives, because nothing is guaranteed in investing. Also, there are some experts who say the common risk advice is wrong, but maybe I'll elaborate that in a future video. In my experience, as your yield goes up, your risk profile tends to go up, and that's what chasing yield is, which is prioritizing very high yield in your investing decisions in hopes of getting a better return faster, rather than ensuring the company is strong. So sure, in the short run, high yield investments may work out, but pushing too hard for income from high yield stocks often burns you, because chasing yield often means chasing trouble. Using a workout analogy, chasing high yield is kind of like one rep maxes. It feeds the ego in the short term, and you can learn things, but it's also easier to get hurt and it's not very sustainable. Or maybe a baseball analogy is better. Do you primarily focus on singles so you can maximize getting on base, aka do you invest conservatively, with yield being only a portion of your focus? Or are you swinging for the fences on every at-bat, aka chasing yield? Of course, that's not to say high yield investments can't work out great. I just caution you to not over-index on them in your portfolios. Some people jumped into ExxonMobil last year when it crested a 10% yield, and those folks are pretty happy right now. What happened to Exxon was that the share price tanked because of the pandemic and because of an oil war that was going on. Those two events exacerbated an oil panic sell-off, which then caused Exxon's dividend yield to skyrocket. Oil stocks generally give a higher yield because many see it as an out-of-favor asset in a declining industry, and that's part of the risk aspect you need to incorporate if you're thinking of investing in it. Yield can sometimes be an indicator that there may be some risks or issues present for you to research. You always need to understand a company before you invest in it. How they make their money, what competitors they have, how their various financial metrics have been trending, how their industry is evolving, etc. All of those things are useful so you can make a more educated investing decision, such as is something a great deal because the market has overreacted to something, or is it a bad deal and the company has been beaten down appropriately by the market and now has a risky high yield. I created a video called How to Analyze a Dividend Stock in 60 Seconds to show you how I start to analyze a dividend company, and if it passes my 60-second check, then I do a deeper dive like I've shown you in my original lengthy portfolio reveal videos I did when I started my channel. I encourage you to really understand your companies if you're going to invest. Don't make knee-jerk buy or sell decisions. Unfortunately, some people don't have the patience for dividend investing, especially younger, newer investors. Every so often I get comments like, I can't invest for 30 years before I'm making a ton of money, I want it now. I can't help but think of Veruca Salt from Willy Wonka when someone says something like that. And I'm talking about the Gene Wilder version. Here's a comment on my Dividend Snowball video where someone said, yeah, it looks like people are going to be old or dead with a lot of money. So I guess he wasn't too motivated by the slowly growing dividend snowball I showed. Or here's another comment I got. Nobody waiting damn 50 years. We need that money now to turn to 20 million by 50 years. My gut tells me that comment was from a younger person, a newer investor. Now don't get me wrong, I understand how 10 years or 40 years or whatever seems so long. But believe me when I tell you that 10 years will pass you by in a blink of an eye, and you will look back at this very moment and wish you had started investing, or that you had invested more of your salary and lived more frugally. Even if we have a monstrous market crash today, I bet you in 20 or 30 years from now you'll still be thinking too bad you didn't invest more right now, even before it crashed. If I look back at the year 2000, i.e. right before the mega.com crash, I now wish I had invested more, even before that crash. The same is true for the 2008 banking crash. Obviously, I'd like to prefer investing after the crash versus before, if I had a crystal ball, but I'm also being realistic. I also understand that it could take the markets 5 or 10 or even more years to get back to their previous peaks. I could easily have a portfolio of 4x to 5x what I have right now if I had lived more frugally and invested more early on, before, during, and after crashes. I wasted lots of money on crap rather than investments over the years. Fortunately, I invested some and kept investing even when the markets crashed and looked terrible. I've worked with countless people in their 40s, 50s, and 60s, all of whom unfortunately had zero invested in stocks. Some of them I started working with in my 20s, and then as I moved between jobs, I often ran into the same people who also had switched jobs. When they were in their 20s, I heard things like, what's the point in getting a few $1,000s in a company match? That seems so small. So they decided a 401k wasn't too useful. Then as they got in their 30s, I heard things like, I plan to invest when I'm making more money down the road. As they got in their 40s, I heard people saying, I feel like it's too late to start investing now. Of course, I tried to influence them to invest regardless of their age. Anyways, I had a comment this week from someone who said that dividend investing and ETF investing isn't a way to make money, it's a way to retire. He said young people want Jake Paul and Mr. Beast money now. So the problem I see is that those types of people need instant gratification and don't want to put the time and effort investing requires in order to get to a point where you feel like you're doing well. That's true for most anything in life that you want to excel in. You want to get that six-pack? You can do it, but it will take an extended commitment over a period of time. So taking that back to yield, some people don't have the patience to invest slowly, so they see a stock with a super high yield and buy it without researching it and understanding if it's a diamond in the rough or justifiably low. So why does Altria have a higher yield? Well, a key reason is because people see sin stocks as having more risks. Some people shy away from them for personal or ethical reasons. It's not hard to see that cigarette usage has generally been on a decline in most places, so manufacturers counter that decline with price increases and product innovation. We also see decades of government regulation that prevents that industry from advertising, that keeps raising taxes on them, etc. And of course, people have become more educated to long-term health effects, which has also acted as a drag. Get it? I made a pun. All those things have added headwinds for those types of sin stocks, and the more the stock trends down, the more the yield goes up. Of course, there's financial metric trends you gotta dig into as well. There are lots of assets that have higher than average SP 500 yields, each with its own pros and cons and risks and such, including covered call ETFs, mortgage REITs, closed-end funds, BDCs, 2x leverage plays, etc. Now, even though you don't want to chase too high of a yield, it's also reasonable to build a portfolio of yields that meet your risk tolerances and needs. Okay, now with that info shared, let's go over the stocks. The first one is Iron Mountain, ticker IRM. Iron Mountain is most commonly known as a data record storage REIT, both for physical paper and digital data. And now they're pushing into aspects of the data center business, which should accelerate their growth. They have a consensus analyst rating of a hold and have a nice 10 consecutive years of dividend increases, though I think if they end up not paying out more in Q4, they lose that streak. They have a great 5% yield, but have a low 3.41% 3-year dividend CAGR. Since it's a REIT, we don't focus on payout ratios or PEs, but I believe they're around a 75% to 80% AFFO payout ratio this year. For a while, some investors thought that Iron Mountain's lack of earnings growth might cause them to have to cut the dividend, but they've been growing some financial metrics nicely, and they're focused on expense containment and reduction, so the bears aren't too happy with their stock prices in the last year. It's hard for me to find a great competitor for Iron Mountain because they're quite unique in what they do, so comparisons to something like Digital Realty Trust don't seem appropriate. Their stock price took a hit when the pandemic started, but they have shot back up. Their shares outstanding trend isn't abnormal for a REIT. And then revenue has been trending nicely, and earnings look decent. We see that their assets and liabilities have been growing at roughly the same amounts, which is fine. Debt is starting to climb, so that would be something I would watch as they continue into data centers. I use Dividend Channel's Total Return Strip Calculator for the returns data. We see that year to date, the SP 500 has had a great 23% return, and IRM is even up more at an insane 118% because of how hard it fell last year. So the time you really wanted to invest was in November of 2020. If we look over the last 5 years, we see that the SP 500 has had an awesome 17% annualized return, and IRM has had a 19% annualized return, but realize that before then IRM was stagnating for years. Okay, moving on. The next high-yield SP 500 dividend stock that is beating the market is ONEOK, a leader in the gathering, processing, storage, and transportation of natural gas in the USA. They have a consensus analyst rating of a hold, have a great 18 consecutive years of dividend increases, and then they have a high 7.13% yield and a nice 3-year dividend CAGR of 8.64%. They actually have the second highest yield in the SP 500 behind Altria, assuming you factor in AT&T's intended cut. Altria didn't make this list because they didn't beat the market over the last 5 years, like IRM and ONEOK have. ONEOK's dividend is juicy, but I am a bit concerned about it. I calculated its payout ratio in the low 80s, but I'd imagine if there's another significant pandemic impact, then I'd surmise that their dividend might be in jeopardy. But hey, a lot of companies' dividends would be at risk if we see something like March of 2020 again. I think if they don't increase their payout this final quarter, then they'll lose their consecutive years of increases streak. Their stock price has been trending nicely overall, but you can see how the pandemic hit them hard, and then they sprang back nicely this year as oil in the world rebounded. Their shares outstanding trend seems reasonable, and at a low base, though I'd like to see them drive more back to shareholders. Revenue trends aren't that compelling for them, but their latest numbers, which aren't yet reflected in this graph, have jumped up. The same is true for their net income, which again had a much better last quarter, which hasn't been updated yet in this graph. We see that their assets have been growing faster than their liabilities, which is good. Debt has been trending in the wrong direction for a while, but in the last quarter they started chipping it down. Beyond watching for dividend coverage, debt is another area I'd watch to ensure their leverage doesn't drag them down too far. We see that year-to-date ONEOK has had over a 70% return, though that's inflated due to also being down exceedingly much due to the pandemic. I thought this picture of US electricity generation in 2020 from the US Energy Information Administration would be helpful. It shows us that renewables like wind, hydro, solar, and geo are at 20%. Nuclear is at 20%. Coal is at 19%, and natural gas is at a whopping 40%. So while we continue the march towards renewables, I think natural gas is still in a great spot, as companies like ONEOK are flowing with cash. And as we transition away from coal, then cheap natural gas often becomes a potential many turn to, not to mention it's the most environmentally friendly fossil fuel because it burns cleaner. And if you do invest in renewables, then yield often suffers because it's such a popular space these days. Some other of the highest yield dividend stocks in the SP500, which are beating the market year to date but aren't beating it over the last 5 years, are Kinder Morgan, ticker KMI, Lumen Technologies, ticker LUMN, Altria, ticker MO, Williams Companies, ticker WMB, and ExxonMobil, ticker XOM. Anyways, before I end this video, I wanted to mention that a subscriber of mine named Chris suggested that I add in the hourly wage income equivalent in my dividend spreadsheet tool, since dividend income is more powerful than wage income due to taxes and such, which is actually something I used to do and first talked about in a video I called How You Can Make More with Dividends, but then removed it when the spacing didn't fit as I was evolving my spreadsheet. Basically, the median hours worked in a week in the USA is 34.4, and the average tax in the USA are 14.6%, whereas with qualified dividend income you can avoid federal taxes up to over $100K for a married couple. So after Chris's comment, I asked my Patreon Aristocrats and King and my private upper tier Patreon channel on my Dividend Discord if they'd like me to re-add that metric back in, and they voted yes, so I'll start including it going forward. Here's what it looks like now in this beta version of my spreadsheet. So you can see my portfolio's annual dividends are at about $82K a year, which is around $6,900 a month, or $1,600 a week, or $226 a day, or $9.44 an hour around the clock, 24 hours a day, 365 days a year. That means it's equivalent to a $53 an hour job when you factor in what the dividend income's buying power is relative to average hours worked in the USA at a 9-to-5 job, including factoring in potential tax benefits that some dividend income has versus wage income. Dividends are truly amazing. Now I'd like to shout out my latest Patreon Aristocrats who have recently signed up, something I do because I really appreciate them for supporting my channel and my goal to help educate the world to the wonders of dividend investing. So thank you G-Man, thank you Antoniadis Nicolas, sorry about that, who used his full name signing up on my Discord, so I'll use it here as well. Thank you Jared808, and thank you Sven Bitez. As Patreon Aristocrats, they gain access to my dividend portfolio tracker spreadsheet tool I use in this video, along with they gain access to multiple private channels on my Discord, including one where I let people watch my videos before I release them to the public, as well as I often let you vote on which thumbnails I use for my new videos. I'd also like to do a special shout out to Sean D, who just signed up at my highest tier as a Patreon King, which gets him all the perks of my previous tiers, along with a 30-minute monthly private Discord call with me to talk about whatever he wants. Some people sign up at the King tier for multiple months, and even years in some people's cases. Others like to sign up for 1 month so they can get a chance to pick my brain for 30 minutes about their portfolio, or some stock they're thinking of investing in, or whatever. Anyways, if you appreciated this video, then please kill that thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching and clicking the like button, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.